So we'll see how this pans out in terms of management commentary. But for now, looks like a strong operational performance coming in from Hindustan Unilever. We also have Abneesh Roy, who's the ED at Nuvama Institutional Equities, joining in now. Abneesh, what would you give more weightage to? This EBITDA beat that the company has reported, or a mild miss on the top line that the company has reported?
Yeah, it's a decent number given the rural slowdown, given the pricing which is easing off in the base. They have given back the price cuts. So those things are impacting your sales, etc. And that's why if you see F&R also is a bit weak, and top line definitely looks a bit weak on YOY basis versus expectation. It's in line, but yeah, the key I think takeaway will be 9% EBITDA growth and good gross margin expansion. So finally we are seeing that gross margin expansion is stronger than expectation. Plus good that company is investing in terms of advertising very strongly, as you rightly said, 65% higher, 400 basis back towards advertising. But the good part is gross margin expansion is also flowing towards EBITDA margin expansion in a reasonable manner. Going ahead, yes, valuation comfort is good in Hindustan Unilever because stock has underperformed, and overall there is a slowdown in the entire sector. But this is a decent performance. I think the slight miss in terms of the sales and volume growth number, I think that's also in the context of the whole inventory destocking because of the price cuts which have happened in soaps and detergent, etc. Now, because crude is coming back, that's in fact good for HUL from a local competition perspective. So overall, yes, decent set of numbers, and the stock has very limited downside. The stock has corrected. So from medium long term, the stock is looking good.
All right, medium long term, the stock is looking good. In fact, Abneesh, I'll ask you to just hang in there with us itself. Or the company has said that the growth is being led by urban. We have the presentation with us. Urban market this time around has grown about 3%. Rural market has declined by about 1%. We've also looked at the competitive intensity increase. The volume growth for small players has increased by almost 6 times as compared to last. This is in detergent bars. But I'm just trying to look at what the management outlook for the near future is. The underlying sales volume growth is coming at 2% versus street expectations of 3 to 4 odd percent. And going forward, what they're targeting in terms of consumer business, they're saying they expect tailwinds coming in from a better festive season. Rural recovery is likely to remain gradual. Competitive intensity continues to remain high, watchful of volatile commodity prices. They say that price growth will be marginally negative if commodity prices remain where they are. They're focused on driving competitive volume growth, and they will maintain EBITDA margins in a healthy range whilst investing competitively behind their brands and long-term strategic priorities. So those are a couple of points that have come in from the management commentary from a near-term outlook standpoint. It's a resilient and a competitive growth that the company has reported while stepping up their EBITDA margins and increasing their ad spends by about 420 basis points. Your thoughts on, how one should look at HUL results from an entire FMCG standpoint, their management outlook from an entire sector standpoint, Abneesh?
Yeah, I would say it's still initial days of the results, so we'll get more clarity as other results come. But I would say that currently our topics will be Nestle, Tata Consumer, Godrej Consumer, etc. HUL, yes, decent show, but in case of HUL, rural exposure is higher than, say, a Nestle. So rural slowdown impacts HUL more than a Nestle. Second is local competition has come back in detergent and to an extent soaps, etc. Plus in FNR, HUL still has the issue of the Horlicks volume growth and Horlicks raw material issue in terms of the gross margin compression. I would say that in Q3, clearly the volume growth trends for HUL and sector will improve because of festival demand coming back. Rural also, August month was a write-off, but September month the rainfall has picked up dramatically. Plus now we are seeing government give very good MSP hike. Wheat MSP hike has been at a 9-year high. So yes, on the margin, things will improve for HUL also. But I would say currently results on Nestle were superior to HUL's performance in this quarter because Nestle is a much more urban-focused company. Plus, definitely categories are also different.
All right. The company said that in this quarter, there was a one-off credit coming in from a favorable resolution of past indirect tax litigation benefiting both top line and bottom line. If you exclude this, the underlying sales growth would have been 3%, underlying volume growth would have been 2%. That's understandable. The EBITDA margins would have been 23.8%. And the net profit growth would be about 7%. Nothing really to worry about out here. Nothing untoward that the street did not know. Final thoughts, Abneesh. Tomorrow the stock opens in the green according to you. What are your thoughts?
Yes, I think near term, the 9% EBITDA growth should support the stock, given the stock has underperformed, has seen correction. And definitely in terms of outlook for Q3 for all FMCG companies, things are better than Q2. So yes, definitely. And crude also going up, that lessens the competition in the future from local players. So detergent clearly is linked to the crude oil pricing. So if crude comes back, that's good for Unilever in terms of lesser competition from local players. So yes, it should be green hopefully in the near term because of all this.
All right, take that point, Abneesh. Thank you so much for joining in. So just to wrap things up for you, if you've just tuned in, HUL Hindustan Unilever has reported their numbers. The revenue coming in at 15,276 crores, which is a 2.6% jump as against the last year. But as compared to a poll, it is 15,320 crores. So largely in line, a mild miss out there. The EBITDA, a big beat on our expectations.